tariff threats are receding and it's stock markets which are benefiting. Good morning everyone and welcome back to Morning Markets at True Potential. The first week of every month, the focus on economics is always dominated by US jobs data. However, in the background, of course, we have the threat of tariffs from Donald Trump, but they are now receding, and that is why stock markets are benefiting so much. And in fact, the S&P 500 has just had the strongest May since 1990, an incredible month which demonstrates that, again, sometimes the best months for stock markets are crowded very close towards the worst, and April was a very poor month for global stock markets. However, Donald Trump seems likely to agree to a number of trade deals in July, and that's why he's asked for a number of countries to escalate their proposals to his administration this month. So it looks likely that tariffs will in fact come down, but will likely end up higher than where they were at the start of the year. But markets can take that, knowing that global trade is fluid and that global exporters will find a way to get to their end customer. So back to the basics, which is the jobs data in the US, and it continues to demonstrate that the tariffs so far have just been a blip. Hiring intentions remain strong, and yesterday we saw in the jobs data, the JOLTS, which is both openings and those who are leaving employment, continues to reflect normalisation. So we are likely to see strong data in these measures, but perhaps poorer data in the sentiment surveys, those where there's more of an emotional input into those. And that's likely to again be reflected in some of the ISM surveys which come out this afternoon for services. We're likely to see some more pessimistic outlooks for employment there, just because tariffs have dominated so much through February, through March and through April. However, underlying data again points to a bounce in US growth, if we remember that Q1 saw a modest contraction of 0.2%. Early readings for Q2 are growth of around about 4.5%, which would suggest that annualised growth in the US is still around 2.5% overall, which is incredibly strong and above trend. All of this, of course, means that the Federal Reserve are in no rush to cut rates, but it also suggests there is no need, with underlying inflation close to 2% but above, and policy rates at 4%, then there is room to cut rates should there be any future weakness in employment. But that's not what the surveys are indicating. And elsewhere, global growth outlook remains strong. The German Bundestag have just trying to pass a new fiscal initiative for corporate incentives for investment, and this again reflects that there is a new growth momentum building in Europe. And with rates there going lower, likely to go to 2% over the summer, then again it's a great backdrop for both equities and bonds to do well. So that's all for today. It's an optimistic assessment given the receding threat of tariffs and that the economies continue to remain strong. Please join us at the end of the week where we'll summarise the US jobs data, in particular the non-farm payrolls. Thank you.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value and you may get back less than you invest.